Let's get in a prominent voice then as to what the road ahead for the Indian markets looks like for the year 2012. Robert Wandisford, head of India and Southeast Asia economics at Credit Suisse, now joins in on the phone line from Singapore. Robert, great to have you with us on the show. What is your prognosis for the year 2012 for the Indian equities, and what probability would you perhaps assign that it's going to be better in terms of returns for investors?
Well, actually, I'm reasonably optimistic. Cautiously optimistic is perhaps the best way of describing it. Having been, negative for the last 12 to 18 months. The reason for that, I think, is primarily about inflation and what that implies for interest rates. I mean, it seems obvious now that inflation has peaked, is coming down, is actually coming down perhaps more sharply than a lot of people expected. I think we'll see it down to 7.5% when we get the December number. I think we'll see it down to 6.5% when we get to January, and I think it's going to fall further thereafter, triggering a sequence of rate cuts. Now, while clearly that won't have an immediate positive influence on economic growth, it will with a kind of 12-month or so lag. So inflation is getting better, interest rates are going to be cut, and eventually growth is going to get better. And from my perspective, from my macroeconomic take, those are three potential positives which we didn't have clearly in 2011.
Sure. Robert, you did talk about the positives working for India being the fact that inflation is going to come down and interest rate cuts could begin. But on the negative side, do you believe foreign investors could, stay away from India simply because of the government's finances continuing to be in a mess? The fiscal deficit likely to only get worse. The trade deficit, looking like it's going to get worse from here on. Do you believe that could hold foreign investors back from entering India?
I think it might do for the time being, but probably not throughout 2012. I think the much bigger threat really concerns the Eurozone's fundamentals, and I suppose the US fundamentals as well. I mean, clearly if we see big problems continuing in the Eurozone, and obviously in the worst case scenario, Eurozone breakup, that will have a much bigger influence and mean that money is pulled out of India and indeed emerging markets in general and brought home. But assuming that does not happen, clearly India's twin deficit problem is not new. It has been around for some time. India's had, in fact, much higher fiscal deficits over the recent past than it's heading into. It's not a new problem, and I just feel that the mood is very depressed now, and there's quite a lot of pent-up demand there, waiting for some good news, and I think that good news is coming. So while I would suggest that maybe we've got another month or two of difficulties, and I think the market could fall a little bit further in the very short term, I do think as 2012 progresses, foreign investors are going to start warming up to India, and perhaps in quite a significant way.
Sure. And Robert, just one very quick word on the rupee, because that also continues to remain a concern for foreign investors. Do you believe the rupee is going to go to levels of 55 and 56 that everyone's been talking of before it maybe begins to turn?
I doubt it unless we get a sort of huge risk-off type of event. If the Eurozone problems intensify once again, then there's very much a possibility. But on the basis of India's own fundamentals, I think we are pretty much at the low, and I would expect it to see it significantly stronger in the next 12 months on similar arguments, really, that foreign inflows start to re-emerge as the macro situation improves.